Hey, stock compounders, Brad here. So today I want to talk about when to sell stocks. And at the end, I'm going to give you my framework for how I determine the exact point for when I sell stocks. But first, I want to share a few stories that might help you kind of think about what might be best for you in terms of when to sell stocks. So the first thing I want to talk about is Guy, Spier, and Crystal. Okay. Now, Guy Spier is a friend of Monish Pabrai. He's a great value investor. He's included in that list of super investors through Dataroma. Now, Guy had a brilliant idea at one point. It was early 2000s. He decided, all right, I'm going to find great companies in the U.S., companies with a huge moat, great long-term competitive advantage, and I'm going to look for similar companies in developing countries. So one of the companies he really respected is Moody's. Moody's is a rating agency. And so he was looking around the world for other companies like Moody's. And he ended up finding a company called CRISIL in India. He bought in 2001, I think it was like $11 per share. And he put a couple $1 million into CRISIL at $11 per share. Now, 4 or 5 years go by, and the stock has 4x'd, okay, in 4 or 5 years. So at that point, he decides, okay, I've got a 4x. I'm going to sell. I'm pretty happy with the 4x. So he put $2 million in. He ends up with $8 million 4 or 5 years later. Now, if he had held on to CRISIL from 2001 to today in 2020, that CRISIL position would be worth over $300 million. Okay, CRISIL over that 19 years went up 147 times. The current portfolio of Guy Spier is about half of that $300 million. So CRISIL would make up 2/3 of his portfolio if he had simply held on to it. So, that's the danger of being too eager to sell, especially being too eager to sell your winners, all right? Now, it's commonly said from professional investors, it's much harder to know when to sell than it is to know when to buy. I mean, knowing when to buy is fairly easy. You've got a stock that's, got a big margin of safety compared to what the stock is actually worth as supported by the business fundamentals. Knowing when to sell is a lot harder. Do I sell after a 3, 4, 5x? Or is this a company that's a long-term compounder? Is this a company that I just need to park my money with and let the business grow my wealth for me over time? The next thing I want to mention is the coffee can approach. So the coffee can approach was brought to my attention by a guy named Chris Meyer. He wrote a book called 100 Baggers, Stocks That Return 100 to 1 and How to Find Them. And I want to just read a short thing from this blog post that Chris Meyer posted about the coffee can approach. The coffee can portfolio concept harkens back to the Old West when people put their valuable possessions in a coffee can and kept it under the mattress. The success of the program depended entirely on the wisdom and foresight used to select the objects to be placed in the coffee can to begin with. The idea is simple enough. You put together a portfolio of your favorite stocks for the long haul. Then you let them sit for 10 years or more. You incur practically no costs with such a portfolio, and it is certainly easy to manage. You're just letting it sit there. The biggest benefit, though, is that it keeps your worst instincts from hurting you. Okay? And then he talks about an example of the coffee can approach. The potential impact of this process was brought home to me dramatically as the result of an experience with one woman client. Her husband, a lawyer, handled her financial affairs, and was our primary contact. I had worked with this client for about 10 years when her husband suddenly died. She inherited his estate and called us to say she would be adding his securities to the portfolio under our management. When we received the list of assets, I was amused to find that he had secretly been piggybacking on our recommendations for his wife's portfolio. Then, when I looked at the total value of the estate, I was also shocked. The husband had applied a small twist of his own to our advice. He paid no attention whatsoever to the sale recommendations. He simply put about $5,000 in every purchase recommendation. Then he would toss the certificate in his safe deposit box and forget it. Needless to say, he had an odd-looking portfolio. He owned a number of small holdings with values of less than $2,000. He had several large holdings with values in excess of $100,000. There was one jumbo holding worth over $800,000 that exceeded the total value of his wife's portfolio. So, you put $5,000 into a stock, it's $800,000 now. That's 160 times just by buying and stashing it away, forgetting about it. And he goes on to say, holding onto a stock for 10 years is hard. So much can change. The rides up and down can be gut-wrenching. But to nab really big returns, you need time. And to get that time, you need to suffer some big drops along the way. So that's the coffee can approach. Try to identify companies that are great buy and hold companies over the long term, what we call these long-term compounders, and forget about them. Don't watch, every little wiggle that's happening with the stock price. So the next thing I want to share is there was a study done called the Corporate Longevity Forecast. This relates to the coffee can approach. And the study found that back in 1964, the average tenure of companies in the S&P 500 was 33 years. Okay, so businesses that made it into the S&P 500 were able to hang around for a while. Now, by 2016, the average lifespan in the S&P 500 dropped to 24 years. It's predicted that by 2027, only 7 years from now, the average lifespan of a company in the S&P 500 is going to be 12 years. Okay, so this is concerning from the perspective of the coffee can approach. What this tells me is that it's going to be more difficult to pick the right companies that you can just forget about for 10, 20, 30 years and then open your account decades later and see that this thing has gone up 100 times or 150 times. It's harder for businesses to kind of enjoy a comfortable position at the top. There's what this article is calling creative destruction. Creative destruction is accelerating. So, that makes me a little bit more nervous about the coffee can approach, because for the coffee can approach to work, you really have to have at least one of these 100 baggers, these long-term compounders. Okay, if you don't have any, it could be a challenging approach. So that's concerning from the kind of buy it and forget it perspective. That's not to say that it won't work. It just seems to me like it would be harder today than 50 years ago. So when to sell stocks? Monish Pabrai, for the first maybe 2 decades of his investment career, his approach was to buy at about 50% of value. So you've got a 50% margin of safety. If a stock is worth $10, he wants to buy at $5. And then he's basically holding until the stock gets to about 90% of intrinsic value. So it's worth 10, you buy at 5, you sell at 9. You don't want to, he didn't want to wait right until 10 because, maybe the price never quite gets back to the intrinsic value that he came up with. These days, Pabrai isn't looking for those kinds of opportunities anymore. He doesn't want to buy discounted pies and then turn them over every 2 or 3 years because that's a lot of work. You've got to find new opportunities to buy 50-cent dollars constantly. So his approach these days is to find hidden compounders, companies that are these long-term compounders, but people haven't recognized them as such yet. Because when everyone knows that you've got a long-term compounder, like Visa, Moody's, MasterCard, Amazon, Apple, Microsoft, there's all these long-term compounders, these great businesses, but people know they're great businesses, and so they're expensive. The price-to-earnings ratio is very high. And Pabrai is a cheapskate. He doesn't like to pay a premium for great businesses. So his whole thing lately is to find hidden compounders. Buy companies before people know that they're compounders. Now, and that's great. I track what Pabrai is buying, which gets me to the point of what I do, how I decide when to sell. So a really easy way to decide when to sell is first to only buy stocks that super investors have bought, that super investors currently own in their portfolios. And you can see what stocks super investors own by going to Dataroma, by looking at 13F filings from these great investors that are available on the SEC website. And my approach of selling, so I wait until it's publicly known that the super investor that owns the same stock that I do, so say I buy Facebook, and I know Michael Burry recently bought Facebook. I know Seth Klarman recently bought Facebook. All I have to do is wait until I can see that they have sold out of Facebook. Let them make the buy decision for you. They have decades of experience compounding capital, okay? This is what they do. So, knowing when to sell is a lot harder than knowing when to buy. But we don't have to decide for ourselves when to sell. We can copy that, that process from these great investors and wait until we can see that they have sold before selling ourselves. And that's really my approach. It's kind of my twist on the magic formula investing strategy. So I'm using the magic formula to decide which stocks to buy in one of my portfolios. And all 5 of those that I bought just, I think it was just a week ago, I bought 5 stocks for the magic formula stock portfolio. And all of those 5 stocks are owned by super investors. And I am not going to sell any of those 5 until I see that the super investor who owns each of those has sold out of their position. Okay, so it's I think it's just a fantastic hack for letting the professionals do that work of figuring out when to sell for you. So that's my big kind of hack in terms of the exact point of when to sell stocks. And, I'll just say one more thing, guys. One of the biggest mistakes that professional investors make is, say they have a portfolio of 10 stocks and there's a couple that are doing really well. There's a couple that have gone up 3, 4, 5 times. Usually it's a mistake to trim those positions, okay, to kind of realize profits on those. Say you've got $100,000 worth of a certain stock. It goes up to $500,000. You sell $300,000 or $400,000 just to kind of lock in the gains, and then you take those gains and you put those in companies that are kind of on the lower end of your portfolio, companies that are still undervalued, that haven't performed recently, thinking, well, if I take money away from these companies that have maybe gotten a little bit expensive and reallocate them to the companies that are still cheap, I'll probably do better, right? And it makes sense that an investor would think that way. But the challenge is, that's also called cutting the flowers to water the weeds. The danger is that, it's possible that these top companies, the companies that have done really well recently, are the long-term compounders, okay? The companies that can really move the needle on your portfolio if you just let them do their thing. So something to consider. I'm not saying it's always a bad idea to trim the positions that have done well, but consider that the surest path to kind of the big returns in your portfolio is to find these great businesses and leave them alone. Leave that money alone over years and decades. So I will leave you with that. Let me know what you guys think about selling. If you have any strategies or tips for knowing when to get out of a stock position. I'm definitely curious to hear from you, because it is a really hard thing to do correctly. I mean, professional investors mess this up all the time. So yeah, curious to hear from you. Let me know in the comments what your approach is. And that's all I got, guys. Smash that thumbs up if you like this video. Hit that subscribe button to see more videos like this about stock investing and kind of financial freedom. And I will see you guys in the next video. Take care.